So the markets have completely 100,000% lost their minds. You are now pricing in a 1% rate hike with almost 100% certainty, specifically 81.5% chance of now getting a 1% rate hike. That means bond yields have to come up in a big way. Look at the 2 to 10 year yield curve. It is inverted 23 basis points, 15 basis points as of today alone. So what is going on in the stock market? Why is the stock market actually positive after seeing 9.1% inflation for June? Well, we are going to get into all of that plus more here in this video. Now, the most important thing I want you guys to do is comment down below. What do you guys think about all of this information that we are going to go over here in this video? Thank you for tuning in. Hit the like button and subscribe to the channel as well because, hey, it's free 99. It's the only thing that has not experienced inflation in 2022. So if you guys are unaware of what is happening today, because boy, it is a big day, well, inflation rose 9.1% in June, even more than expected as consumer pressures intensified. Cost surged for gasoline, groceries, rent, and dental care. Even core CPI, that is excluding food and energy, rose 5.9% compared with the 5.7% estimate. Now, what this is doing, well, it's doing a lot of things. We are now pricing in a 1% rate hike coming by July 27th. Markets have not reacted to that. The bond market has not reacted to that. Whereas the yield curve inversion, the difference between the 10-year and 2-year rates, reached biggest point since 2000. And we are now inverted 0.23 basis points, almost a full rate hike, with the 2 and 10-year spread. So what is this saying? Well, we're going into recession. If not, we're already in a recession, right? There you have that. But you have 9.1% inflation. You now have the markets pricing in with a 67.2% probability of getting a 1% rate hike. That would put the federal funds rate in between 2.50 to 2.75%. That means 10-year treasuries, really all treasuries, have to come up in a big way. Look at the bond yields for the day. It's not playing along. There's a big push and pull, tug of war between what's happening with inflation, how much the Fed is going to have to raise rates, and when we go into a recession. So the markets are kind of trying to call the Fed's bluff here, because if the federal funds rate goes to 2.5 to 2.75%, 10-year treasuries cannot stay at 2.91%. But the markets are trying to say, hey, we have a higher than not probability of going into recession. You guys are not going to be able to raise rates that aggressively. But if the markets realize the Fed's going to do it either way, you're going to see a big uptick in the bond yields, or something is just going to break in the markets. Now, I do think a lot of this potential downside will come off of earnings later in this month, and I obviously cannot forecast how earnings are going to go, but I do think they're going to be pretty negative overall. Now, we did just have Fed Bostic that came out and said everything is in play when asked about the possibility of a 100 basis point July rate hike. So I do think this CPI report, as well as Fed Bostic's comments, are really going to solidify the probability of this 1% rate hike, now at 81.5% chance. If we get a 1% rate hike, the markets are not fully pricing that in right now. The swaps, the futures for the federal funds rate is pricing it in, but the stock market is not pricing it in. So you got to be prepared for some major downside in a very short amount of time at the current moment. You are really in a danger zone. If you don't have protection on your portfolios, maybe it's not a bad time to do so. Obviously, not a financial recommendation. You could always lose money trading options or shorting stock, but we're not in a good situation right now. So just make sure maybe you don't have too much margin heading into the next couple of weeks. Now, what do we have as far as tomorrow? As far as economic data, we have PPI month over month for June. Okay, that's producer price inflation. So that'll be important. And then you also have retail sales month over month for June coming on Friday. And that is expected to come in at 0.5% positive. If we come in positive at all, really, in my personal opinion, or even better than expected, well, that's going to show the economy can withstand rate hikes and potentially not go into recession as quick, forcing the bond yields to react, forcing the Fed's hand to raise rates much steeper than what the markets are expecting. So we are really seeing a very docile day here in the markets, considering everything wrong that is happening under the surface. So you guys gotta watch out for this big downside. It's coming. It's the question of what day is it going to be where you get a massive downside move. It quite possibly could be tomorrow. Now, this is what has really derailed the kind of bullish activity we were seeing not too long ago throughout this part of the day, right? That's what gave us the 0.34% red candle and then some subsequent bigger red candles as well after that. It is the Fed Beige Book. Well, essentially what this is the summary of, what's going on in different districts, right? Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, San Francisco, right? So we're going to go ahead and read this. Overall economic activity. I think this is what moved the markets and gave us that sharp candle to the downside. So it says, economic activity expanded at a modest pace on balance since mid-May. However, several districts reported growing signs of a slowdown in demand, and contacts in 5 districts noted concerns over an increased risk of a recession. Most districts reported that consumer spending moderated as higher food and gas prices diminished households' discretionary income. Due to continued low inventory levels, new auto sales remain sluggish among most districts. Hospitality and tourism contacts cited healthy leisure travel activity, with some noting an uptick in business and group travel. Manufacturing activity was mixed, and many districts reported that supply chain disruptions and labor shortages continue to hamper production. Non-financial services firms experienced stable to slightly higher demand, and some firms reported that revenues exceeded expectations. Housing demand weakened noticeably as growing concerns about affordability contributed to seasonal declines in sales, resulting in a slight increase in inventory and more moderate price appreciation. Commercial real estate conditions slowed. Loan demand was mixed across most districts. Some financial institutions reported increased consumer usage of revolving credit lines, while others reported weakening residential loan demand amid higher mortgage interest rates. Demand for transportation services was mixed, and reports on agriculture conditions across reporting districts varied. While demand for energy products was robust and oil and gas drilling activity picked up, production remained constrained by labor availability and supply chain bottlenecks for critical components. Similar to the previous report, the outlook for future economic growth was mostly negative among reporting districts, with contacts noting expectations for future weakening of demand over the next 6 to 12 months. That is really the summary of what you can point out right here. The outlook for future economic growth was slightly negative among reporting districts, with contacts noting expectations for further weakening of demand over the next 6 to 12 months. So what you have essentially going on right now is this, like I said, a big push and a pull. But what is happening in the stock market is very different from the data that we are getting. The markets are not expecting this actual 1% rate hike. So I think from now on, it could be more important, at least until we get the next Fed rate hike, which will be July 27th, to see what happens with these Fed speakers. Now, the next Fed speaker is going to be tomorrow at 11 a.m. and that is Fed Waller. Fed Waller, he's going to be asked about a 1% rate hike, since the markets are now expecting a 1% rate hike. And if they confirm and they say they are fine with doing a 1% rate hike, the markets might have to take it more seriously, and that is going to be a very big deal. At the same time, the inverted yield curve is going to start drawing a lot more attention. This thing has inverted 14 basis points as of today, 167%. So what is the Econ 101 version of all of this? What is the long story short that anyone can understand? Well, either the Fed pushes us into a recession, we will get deflation and potentially more panic in the stock market, but then at that point, the question is not how high is the next CPI report going to be, it's how bad are company earnings going to be. So if that narrative starts to play out, you might see the bond yields not react in the way that they should until the Fed ultimately does raise rates towards the end of July. And once we start to get large company earnings, that's where the question of how bad are things going to get because of this recession actually starts to be asked. On the other hand, we could get good retail sales data on Friday. You could get the markets brushing off the probability of a recession for now. And then the question is, how high will the Fed have to raise rates? How high will the bond yields have to go? And that could actually bring more pain to the stock market the longer we drag out until we get a recession. A recession comes with deflation, but like I said, the earnings situation, how will that be during a recession? But if we don't get a recession quickly, if the Fed has to raise rates, well, the bond yields are going to have to go up in a very big way. That's going to reduce and restrict capital even more, and that will mean more sharp downside here in the stock market. And all of this, I think this question will be answered, at least for the short term, here in the next couple of weeks. By this end of this week, we should have a pretty clear picture of what the markets are concerned about as far as inflation or a recession. So that is the Econ 101 version. If inflation becomes the main narrative, well, bond yields have to come up in a big way. If recession becomes the main narrative, well, the question then is, how deep is the recession going to be? Where is a fair valuation for the stock market? So thank you guys for watching. Hit that like button and subscribe to the channel. You guys enjoy the rest of your day. Have a blessed one. I will see you in the next one.